Hello, this is Teach the Teacher, week 4, and for this week I chose topic support and resistance. I would repeat myself, but I could not resist to go for this topic today because of its self-fulfilling nature. I just find it really interesting phenomena because it works purely because people believe that it will work. So let's go right into it. Um, as we all know, prices on the market tend to change. They go up, go down. They rarely remain the same. And if we would look at those fluctuations, we could notice some kind of patterns, and we could draw two imaginary horizontal lines between which this fluctuation will appear. So those two lines at the top would be called resistance and at the bottom would be called support. Why do these lines appear? So when traders look at the market, they are willing to, of course, take advantage of those price fluctuations. So this is why at the peak, many people would like to sell because, let's say, they made already money at the difference, and at the bottom, more people would like to buy, which would press the price up. Why does it work? Is because traders, when looking at trends, they assume that they will go on, and the same thing do institutions, but with a large amount of money. And just because of this collective attention to the trend, it makes it works. Another interesting thing about this phenomena is polarity principle. It means that what was support becomes resistance and vice versa if the pattern breaks. For example, we have a support line and the trader is buying at the support line, so at the assumed bottom, but the price goes lower behind the support level, and when it would go down, the person would just sell at the same price to avoid any losses, and this would make the what was previously support a resistance, so the price would continue to go down, etc. Now a couple of ways to identify those levels. First way would be swing highs and lows, is again basically looking at the pattern and assuming it will go on from how I understood it. Next is horizontal levels, is even painting those lines at the chart, and yeah. Next would be applying moving average tool. It's a nice tool because it moves with the price, so it doesn't need the it adjusts by itself. We would not need to make it again. It's usually applied in 50, 100, and 200-day frameworks. And the most interesting is Fibonacci retracements. It again works mostly because it is widely used by institutional investors. So 38.2% is some kind of normal Fibonacci retracement for a healthy market. 50% is not a real Fibonacci retracement, but it's just a mean, the middle, that is usually kept in mind of people. And 61.8% is so-called a golden ratio that is really widely used. Not all levels would be have the same strength, and here are some factors that increase its strength, so the probability that pattern will go on. First is if it repeats more times. So if it was 2 times or 6 times, 6 times is high probability that it will go on. Next, confluence, which means that if you would apply different tools and it would show the same result, the probabilities again increases. higher volume of trade. So again, institutions have a greater influence on the market rather than private investors. And a higher time frame. When we zoom out, we can see that yeah, those small fluctuations are just become smoothened, and they don't distract us from the bigger picture and from the actual trend. Some tools for analysis, again, it would be TradingView, which we are already using. There are many charts and visualizing tools. CoinGecko is more for crypto, and DEX tools is decentralized exchange pairs. It has them. And as a final word, a couple of common mistakes to avoid. So first would be overcomplicating the chart with too many tools and making it harder to understand. Next is trading exact prices instead of zones. Also ignoring the broader trend, and finally entering without confirmation. It's not a good thing to do. That was it. Thank you so much for your attention, and let's go now to the last week.